Welcome to Buffetting, the podcast where my wife Kass and I share our conversations on investing with you as we try to keep compounding capital so I don't have to go back to being a carpenter.
And I don't have to go back working with real estate agents. We hope you find it informative and entertaining.
But we are not your financial advisors and nothing we say should be taken as investment advice. As always, do your own research, which is more fun.
And now, without further ado, on to the episode.
All right. The short's off. Our old short is off, a new short is on.
New shorts. It's always good to get new shorts, isn't it? You got to have a set amount of shorts.
Look,
in your cupboard.
The thesis still stands, right? Fundamentally.
Inflation's coming.
Same reasoning through a different instrument.
Build a bunker. No. Yeah, so basically, I guess the first thing we'll talk about today is that at first we were really excited about shorting high yield debt and corporate debt.
Yes, that made way more sense.
Yes.
Because it's like, in front of our minds was like, what if the government comes in and bails these, zones out?
Yeah.
Because there's such a big amount of money in big funds that are like connected to retirement funds and everything. So bailout was like, okay, well, how can we kind of protect against that? So corporate debt seemed to make more sense to us.
Exactly. Yeah. So there seemed to be less chance of the high yield and corporate debt getting bailed out, as opposed to the other bond markets, like the treasury bond market. But what we realize is that because we're not really betting on like an economic collapse, we're more specifically focusing on interest rates having to rise. And then maybe eventually that will cause some kind of recession. But at the start, we pretty much think that the first thing that's going to happen is interest rates are going to go up. And the thing that is most affected by interest rates going up is long dated bonds. So bonds that are locked in for a long time. Mm. And what that means is that the high yield ETF we were short, HYG, it had an average duration of 4 years. So what that means is that in about 4 years, all those bonds are going to be sold, or going to basically run out. So they're getting paid a percentage for the next 4 years, and then they get back their $100 they've given the company. So they actually get back the capital in 4 years. Mm. Okay, so that's something that I knew, but I wasn't really thinking about it properly. And
well, we knew that ideally it's not long enough. Like when we bought the options, like it'd be good if it was a longer term, but this is junk debt. That you've got the default risk, which just makes it even worse.
So it makes it even worse, but is that likely to happen?
Yeah, we're not. Our thesis is actually not tied to the default of these companies and the default of the debt. The thesis is tied to interest rates going up and it being a really poor return for you for the coming years.
Exactly.
So a 4-year run rate or
a 4-year
term.
Yeah, term.
When you've got bonds that are 10, 20, 30 years, it's actually probably not the most ideal spot to place your money in.
To bet on a massive decline in price. Yeah. Because at the end of the day, when you run the valuation and you anticipate getting $100 back in 4 years' time, the earnings aren't quite worth as less as another bond ETF that's got the payments locked in for a long period of time. Mm. So,
which is why we did LQD, because their term was longer.
10 years.
10 years.
Yep.
Still corporate, because, the thought of treasuries to me just seems like
that's
a treasury bond. It's like tied to the government. It's like, but when you realize that the government, if they're raising interest rates, they can't come in and bail out bonds at the same time. It's like, well, maybe they can. I guess we'll see if they do, but it's contradicting each other. It's like a contradictory action.
Yeah, exactly. It's stimulating while you're tightening, which wouldn't make much sense.
Yeah.
Because all the times in the past, there's been no inflation. There's been no reason why they couldn't come in and bail out. There's been no consequence. But this problem they're trying to solve right now, or they will probably, hopefully, have to solve, and they hopefully will get motivated to solve, is to stop the inflation. And for that, you have to make things tighter in the financial system. So thinking more deeply about like what exactly we thought was going to happen made us think to look for something that's a bit more longer dated. So that just means that the bonds that in the ETF that we're now shorting. So just to be clear, what we've done now is we've sold out totally of the puts and of the puts from HYG and LQD at a loss.
Yeah.
I think they went up a little bit, and then obviously the market's very illiquid. So that's something everyone should be aware of too, is that if you want to sell, the orders may not go through on the day, and that's what happened to us. So basically we're like, okay, do we wait a bit until HYG and LQD go down again, and then the options will appreciate, because the ratio, when the ETF moves like 1%, your options move like 30 to 40%. So that's where you get your leverage from, and that applies if it goes down as well. So you can only lose 100% of your money, but if HYG goes up 5%, stays up 5%, the option will.
And I think we could have held out and not sold and waited for the next Fed meeting, and probably like the days before the meeting, they probably would have turned us a profit. Maybe. Or the days after it.
Yeah.
But when you're trying to keep the bigger picture in mind.
Yeah.
You just got to kind of disregard these little losses as, we probably rushed into it because we wanted coverage.
Yeah, it's better to have, and that's what we learned from the last thing with the virus, is that it probably wasn't the best possible thing to do, to just buy puts on those travel companies. But we did something.
We just,
we
wanted to quickly do something to have something there.
Yeah.
And then as you develop more of your theory and you have more data, you can make a more, refined calculation.
Yeah.
Which is, I guess, what we feel like we've done now that we've moved over to TLT.
Yeah. Yeah. And the way you can do it is you can go online and do what's called NTA calculation. So there's whole bunch. There's when you're looking at valuing an asset of some sort, you have to either do a discounted cash flow or a NPV analysis. Sorry, it's called NPV analysis. And the only difference between a discounted cash flow and an NPV is that the NPV has an end date. So it's like a discounted cash flow, but it's only for 4 years. So and then you get back capital. And if you do that on a net, what did I say it's called again? NPV analysis.
Yeah. So that just makes up for
net present value. It's called
getting your payment back that you originally bought the bond for.
Exactly.
Because you do get that back, and that is worth something.
Exactly.
So it's not an average DCF calculation.
Exactly.
Which is something new we've learned.
Exactly right. Yep. And that's where bonds are different, because a company, there's kind of the assumption that it will go on forever. And even though it probably won't, all companies are kind of valued that way, that you have a terminal growth rate at the end. So, and then obviously not a huge amount of the value is from 30 year to 100 year, but there's some value in that. Anyway, getting a bit deep now, but yeah, if you go online and you do an NPV analysis on a bond, but you change it from 4 years of cash flow to 25 years of cash flow, right? And then you change your required return or your discount rate or your percentage that you want, and that percentage that you want, that's what changes when interest rates change. So when the interest rate goes up, your required return has to go up as well, because now you can get more money in the bank. So by doing that and by seeing that in reality, then you can see how much the value changes a lot more for a 25-year bond compared to a 4-year bond, even though the 4-year bonds are pretty shit.
Yeah.
So it's a bit confusing, but when you start running the numbers and using some of those calculators, even if you just use the ones online, I think you can do it with a spreadsheet too if you're really smart. But yeah, just use the calculator online to work out, how much the value changes. You can see that, a long-dated bond, even if it is treasuries, changes a lot more in value.
That's what kind of, I don't know, makes me feel a little bit uncomfortable though, because it doesn't take into account any behavioral element to that. So I think people would generally be more motivated to sell their corporate bonds ETF than their treasury bond ETF, even though it's a much worse investment when you've locked your capital in and you're getting that return for 20 years. But it's a treasury bond, and you gotta think about what's going to make that person go in and sell that ETF.
Yeah.
To move their money elsewhere.
Yeah.
And especially when you look around and there's like, where else would people put their money at the moment?
Yeah.
I think about the incentive that like the catalyst to make that change.
Exactly.
And I think there's like stronger catalysts for those corporate ETFs than a treasury ETF.
Yeah. Yeah.
Even if the calculation is way better.
Yeah. Intuitively, it makes sense. Like the other way that kind of manifests itself is the high yield bond ETF. If interest rates are going up, well, they're having like a lot of bonds run out and get $100 back every 2, 3, 4 years, right? Because they're short dated. So they can then reinvest that capital in the newer interest rate, like the newer higher interest rate.
Yeah.
And that's where, even though it's worse, they're worse bonds, you're kind of still protected in a way because you're going to be able to roll over. But yeah, the difference is you're more nimble. The company, the ETFs are more nimble. But at the end of the day, the current yield on the high yield bond ETF is 4.3%, I think. And that's like crazy low. And I do still believe that if interest rates go up quickly, or people start to perceive that interest rates will go up quickly, then that could still crash, and we could still have done fine. I think it's still a fine investment, but it's just not as specific, if that makes sense.
Yeah.
Tricky. But yeah, we're always could potentially change our mind.
We always
change our mind. We always try and improve things that we're doing, and we always try and make it better. So I believe that this is a better option. And we happened to stumble upon, we're listening to Mike Green, was it?
Green, yeah.
Talking to, I'm not sure what the other investor's name is, but it's a real vision interview. I'll link to it afterwards, the podcast. And he lays out the exact thing that we're talking about. But this is like 2 years ago. This is before the coronavirus. And at that point, I think the TLT ETF was he actually mentions the TLT ETF. And he says at that point, 2 years ago, it was paying 3%. And he was talking about a situation where if rates went up, and you needed a 5% return, the ETF is going to fall 30%. So he's like using the same kind of math and same kind of thinking that we are, except that now the TLT ETF doesn't pay 3%, it pays 1.5%, which means that if you want a 5% return instead of a 1.5% return, the ETF has to fall by like 70% or something like that, because you're not going to get a 5% return because the bonds are locked in for 25 years. So that's kind of, I feel like that's still too confusing. I feel like it's still not explained probably as good as I can. But do the numbers, and this is where do your own diligence comes in.
I think it's a really funny thing where when you're speaking of something potentially happening in the future, that's so foreign to what is happening right now.
Yep.
You can't really appreciate the value of it in the moment. Because if we do start seeing, in the next couple of Fed meetings, they actually do start raising rates because they have to, right? They've got to start dealing with inflation.
Yep.
This is really bad.
It's really bad.
They're letting it run away from them. They're still buying bonds. They're still pumping money into the market, and they're not touching interest rates yet. Yeah. And so it's still foreign for people to be living in an environment where, capital is expensive. Yeah.
It's still kind of foreign. People still aren't used to it. And the reality is that they have to start getting used to it. And
they're going to see it happen, is what I'm saying. As interest rates do start going up, and they're going to have to go up at the rate of change, we have no idea. But they're already, too late. They're already too late. So how quickly do they have to be increased? At what pace? But as soon as that starts happening, then people will sit down and be like, okay.
When's this going to stop happening, and will it ever stop happening, or are we locked into this now?
Yeah, I can actually see my dollars being eroded.
Exactly.
I can actually feel inflation eating away my purchasing power now.
Yeah. exactly.
When
right.
it starts happening, it's almost like, but you could see it's going to happen now.
Yeah, but then it will actually begin to happen.
Why isn't it appreciated the same?
Exactly. So I was just going to read that thing from Druckenmiller.
Oh yeah.
That we saw that. So like the number of, and this is not a, I mean, people are pretty happy to use the word cloning. They're happy to clone famous investors in their investment ideas and their investment styles. But that can just be like confirmation bias. Obviously, you can find any, so there's so many investments and so many investors, you'll be able to find a somewhat intelligent person, saying a positive thing about any one of your investments, probably if you really try. But the amount of smart people who are now saying inflation is not transitory is getting ridiculous. Like David Einhorn, we just heard today on that interview with Mike Green, talking about how he does not believe it's transitory for a number of factors that we haven't even really considered that yet. Like he was talking about the underinvestment, and he was talking about how because the stock market is so short-term focused and focused on buybacks and that kind of thing, the incentive for companies to actually make big long-term investments to sustain like the supply of things that we need, like cement and timber and all that boring stuff. Like this isn't Tesla stuff. Yeah, exactly.
Stuff we need.
Stuff you need.
And have very capital intensive structures to keep them going that need to be like kept up to date and renewed. And when you're getting ridiculous returns in the market at the moment of tech
speculative
companies,
stuff,
biotech bullshit,
no
one wants to like, okay, let's start building a concrete plant. Like, what's your return on that?
Exactly. So he
let's
was
just buy a tech company. Like everyone's just funneling their money into areas of non-productive growth.
Exactly. And he was saying that even though the prices for things like most commodities are going up, because people believe it's transitory, a lot of the boards on these companies, instead of going, holy moly, the price for copper or the price for whatever, has gone up, let's look at reinvesting in investing in a mine expansion or mine. Most people think it's transitory. So like, oh, we'll just wait and see. We'll just buy back some more shares.
Yeah, it's a better return on our
capital. It's a better
return
on capital than investing because, the prices is perceived to be like a short-term thing. And
they want to keep their shareholders happy as well.
Exactly. Want to keep the share price high. So this like obsession with share price and with managing earnings is also like a very negative thing for inflation because people are not used to investing.
Growth. People just want crazy growth. But no one's actually thinking, well, what do we need as a society to keep the wheels turning?
Yeah.
To keep people happy.
Exactly. Yeah. Cheap food, cheap fuel, cheap energy. That's what you need to keep the economy healthy and keep average people, who are just trying to go about their lives and live their lives, to keep their lives going in a positive direction. Like it's really, that's where the unfairness of it all kind of comes back to us talking about it is like, people who've got capital, people who've done well for a while, have been lucky enough to do well. If you can own some assets, property, shares, whatever, classic cars, anything, it's going up in value, right?
You're laughing all the way to
You're laughing all the way to the bank. And in the meantime, how is the average person's budget being affected? Like power's more expensive, food's more expensive. Oh, lucky you can get a 5% pay rise. Like it's not equal. So that's where you start to think like maybe that's where the asset prices have to come back down. And, potentially we will hopefully get wage growth because there's not a good supply of loads of employees. So people who are skilled, who are doing valuable jobs, maybe they should go through a period of like 10, 15 years where they're getting real pay rises above inflation. Like, wouldn't that be fair and nice? Be great. So
yeah, it's a funny part of this whole inflation story.
Yeah.
Is that if the inflation is actually coming from people's wages, that's money going back to normal people. That's a good side effect of that happening.
Yeah.
But people actually have to come out and scream for these increases. They have to scream to get a piece of the pie. Because you can see how at the moment there's like a massive wealth divide just getting worse and worse.
Yeah.
With these asset bubbles.
Exactly. Yeah.
and companies, they're like all-time high margins across the board.
Yeah.
So clearly, corporations, people, wealthy people are really benefiting at the moment.
Yeah, they're doing fine.
So if that funnels down to average everyday people with wage increases, that's a good thing. But that has to result in a market crash.
Well, margin, at the very least, margin compression, which means the margins of companies go down, you get less profit. So if you want the share price to stay the same with less profit, you have to pay 50 times earnings instead of 25 times earnings. You have to agree to a higher price. So that's where it affects the stock market. And that's where, like, maybe at some point we'll look back and say, look, we probably should have been shorting a lot of things, a lot of companies that were susceptible to, wage cost increases.
I know, but then it comes down to people's perceptions as well, isn't it?
Yeah.
Yeah. Are we in a marketplace where people are even aware of the fundamentals anymore?
Yeah.
25 times earnings seems normal to people now.
I know. What were you hearing this morning about Apple?
Yeah.
Like David Einhorn was talking about when he was buying Apple shares, and he said when you backed out the cash, Apple was trading at 6 times earnings when he bought it. And at that point, people were like negative. People were saying, oh, they're the next BlackBerry, and like they're the next, Samsung's going to take their lunch and all this kind of stuff. Like, it's crazy how perceptions change, and that's why
And what is it trading at today?
And that's where your perspective is always so amazing, like on it, by always focusing on like, okay, I know that there shouldn't be this value, but what is the catalyst to make people change their minds? Because at the end of the day, if people don't sell, things don't go down. Like, that's the reality of it.
And how far can that be pushed?
Yeah.
Like, it's been pushed further than I thought was possible.
I think you've seen it, like, even the last 2 years, you've seen things go from the point where we're finding some things to do, like find interesting things to look at that weren't too expensive, to now being like, unless you want to buy something really old economy, then it's you can't really find much that's good value, which is why we've become like so concentrated. But also have done like a lot of research in the companies that we do hold, so we're pretty confident to like hold through stuff, I guess.
Yeah, but that's, again, why I think, the Fed really needs to come in and change these interest rates quickly, because people, even if they do come in with a 2% increase, that might not change anything for people. People might be in such a state of ecstasy and, Roman Empire shit.
Roman Empire.
That they don't think anything bad can happen.
Let the wine flow. It is a bit like that, yeah. But I'll read this Druckenmiller quote. So the problem is I don't know how recent this is, but he says, he mentions, a 6.7% inflation rate. So like it's probably quite recent that he said this. Yeah. But so this is Druckenmiller. Historically, once inflation reaches this level, it becomes embedded in wages and corporate behavior such that it only falls in a recession. This occurs after the Fed tightens financial conditions materially. The Fed's belief that inflation will come back down to target from 6.8% in the next couple of years, while unemployment goes to 3.5%, as Fed funds are raised to 1.5%, has no historical precedent. Indeed, the great inflation that occurred in the late 70s was subsequent to then Chairman of the Federal Reserve, Arthur Burns, having a 5% funds rate in 1975, accompanied by a 6.7% inflation rate. So I'm skeptical that inflation will behave as the Fed expects with this policy they're suggesting the next couple of years. So like he's really saying that, look, when it gets this high, it ain't coming down unless someone really takes away the punch bowl. And that's what Buffett says, like the Fed's job is to, when the party gets too crazy, take away the punch bowl.
Yeah.
Yeah.
They're not doing the job.
The adult in the room.
They're filling the punch bowl up,
they're
actually.
Saying, we don't want to upset the party. Like, the party is good. Like, everyone's happy. Like, why be negative? Well, if everyone gets too drunk and everyone's up sick, you should take away the punch bowl. Like, it's not a great idea.
Yeah.
So, basically, we're still just as confident, if not more confident than we were a few weeks ago. We spoke to Tom and Frank.
We're confident in our thesis.
Yeah.
Absolutely. Timing?
Oh.
How long can this be pushed on for?
we're listening to like a really old clip of David Einhorn talking about this company that he was short called Allied Financial. And Allied Financial, from everything he said, like a total fraud. Like the examples that he quoted in that clip.
So clear.
So clear. Like, so dodgy. And then we find out it took him 7 years to go broke. So that's what really makes you think, Jesus, like these things can go on for so long because like you always say, love, like, and that's where I was always like focused on what should something be worth. Whereas your perspective is always like, yeah, but why will it?
Why will it? Yeah.
That's great. I love it.
It only will when people agree with you.
Yeah.
Or the earnings, the proof stacks up in reality.
Yeah. So the position size of the short's about 4% of the portfolio. So like with that portfolio that we have, like I feel very comfortable that it will, on average, deliver like close to 20% returns per year. So hopefully, all things going well, we have a drag of 4% until this thing pops, because I don't think that you can ignore it. And like I was saying before, you've now got Drucken, not that you want to use this as your only argument, but when you've got Stan Druckenmiller, not transitory. David Einhorn, not transitory. Bill Ackman, not transitory. Like, these are some of the fastest rising, smartest investors, they have their ups and downs and their good and bad times like every investor, but yeah, like it makes you wonder. It makes you think, geez, crazy stuff. Crazy stuff. Anything else we're doing, love? What else are we doing?
Well, I guess people have asked to really know the intricate details of the options that we're taking out.
Okay.
So, I guess we're happy to share that, but, with options, the timing that you are comfortable with and the price you're willing to pay for it,
yep,
and all the technical details you have to figure out for yourself.
Yeah.
All we can do is like, because you're the one who's sitting there holding this.
Yes.
Writing the ups and downs.
Yep. Saying and if, let's say if you have a 10 grand position, then that 10 grand will be like 15 grand, for 3 or 4 days, and then it might be 5 for 3 or 4 days, and it might be 20, and it might be 7. Like, the volatility is large, and you need to like ignore that if you're going to stay with it. In the same way that if you had like a real-time quote of your car insurance policy, like if there was a market for car insurance policies and there was like real-time location data on cars, then the policy would probably change in price as cars drove through like more sketchy neighborhoods and they came into like good neighborhoods. Like, but would you ignore that, or would you sell your car insurance like as you were driving through these places? Like, you probably wouldn't. You just ignore, like, I'm good, I'm glad I have car insurance.
Yeah.
And that's kind of how we
your
look at
overarching thesis needs to be what you pay attention to. So everyone needs their own way of calculating what they actually think the risk reward is.
Yep. Do you want to cover 50% drop in your portfolio? Do you want to be in a position where you want to make money off it, even if your portfolio doesn't decline? Like, that's all different things people to consider for themselves. But the specific thing that we're doing is we now have a 4% position in 9-month expiration options on the TLT Bond ETF. So that means, I think it's September next year. Mm-hmm. That's when the insurance contract runs out. The strike price, which means that it's basically the price needs to go below this to make any money off the options. The current price of the ETF is $148 and the strike price is $125. So we don't make any money until it falls past.
So you're in the money at
$125. Then your option becomes, worth something. And then I believe that the actual price of the option we bought is $1.60. So every time, once it goes past $125, every $1.60 it goes past, you're doubling in price. So if it goes from 125 to 100, so let's say the share price of the ETF falls from 150 to 100, then once it gets past 125, then you double your money every time it drops $1.60, $1.60, $1.60.
Which is your option price.
Exactly. So if it falls to $100, we make about 20 times our money on the option. So hopefully that's clear.
Yeah, that's what we've done for now. We could change our
and
minds
it could change.
moment.
But well, look, we're back in the HYG ETF. That's the one who's gonna. I don't know. It's very tricky, but I think the original idea was okay. I just think this idea is better. So
I do too.
I'm much happier with that.
Much happier.
Yeah. Anything else, love?
Yeah, no. I think that's a pretty good summary.
Pretty good summary. Yeah. Thanks, Heath, for listening. And yeah, any questions, send them through.
Yeah. Thanks, guys. Bye.
Bye. If you got this far, thank you so much for listening. We really hope you enjoyed the conversation.
Now, if you'd like to become my 22nd
or my 43rd
follower on Twitter, links are in the show notes below. Mitch, anything else?
Nothing to add.